Our next presenter of our conference is Sabina Mexis. Sabina is a senior counsel at Mills Mills LLP. Sabina's practice is focused on tax law. Sabina provides advice on income tax, GST, HST to individuals, corporations, trusts, estates, not-for-profit organizations, and charities. Sabina assists individuals and corporations in the structuring and implementation of tax planning solutions. Sabina also assists clients in resolving tax disputes with the Canada Revenue Agency, the CRA. As part of her tax practice, Sabina advises trustees and beneficiaries of estates, trusts, and not-for-profit organizations. Sabina has an extensive trust and estates practice, assisting clients in setting up family trusts, including alter ego and joint partner trusts, qualified disability trusts, and trusts to hold U.S. real estate. Sabina specializes in complex tax and estate planning for high net worth individuals. Sabina employs a multidisciplinary approach which encompasses all aspects of tax and estate planning, including family law considerations, cross-border planning issues, and philanthropy. Sabina also assists in the structuring of stock option plans and other forms of executive compensation for executives and employers. Around the Mills and Mills workplace, Sabina has come to hold the reputation of tax law superstar, as she is often the go-to person for our tax-related issues. Sabina, please take it away.
Oh my, thank you. I don't know how I can live up to that, but thank you very much for the introduction. I'm just going to share my screen with you. Okay, here we are. So I'm going to be speaking about the tax considerations for carrying on a business in Canada. So why is this not advancing? What is happening? Oh, here we go. Okay, so you know about me, the usual disclaimer, of course. Here's an agenda of what we're going to be covering. And let's start with the general jurisdiction to tax. In other words, at what levels is there authority to tax in Canada? So the jurisdictions to tax are federal, provincial, and municipal. So at the federal level, it will be income and excise taxes, so taxes on goods and services. And at the provincial level, it is income and sales taxes that are imposed. And at the municipal level, it's generally property taxes on real estate. All right, so we have three different types of tax: income tax, excise tax, and payroll tax. And I'm going to, whoops, what have I done? I'm sorry, one second. Okay. So the application of income tax is based on a taxpayer's residence, and I'll be talking a little bit more about residency later on. Although residence is generally a question of fact, there are a few specific rules. So for example, a corporation is deemed to be resident in Canada if it was incorporated in Canada. A corporation incorporated outside of Canada may still be considered a resident of Canada if its central management and control is located in Canada. Canadian residents are taxable on their worldwide income from every source, including business income, property income, investment income, and gains arising on a disposition of capital property. Excise taxes are a value-added tax, so you may be familiar with it as VAT. So we have similar value-added tax in Canada, and it's 5%, and that's imposed on goods sold or rented out and on services provided in Canada. And it is imposed at the place of supply in Canada, and I'll be speaking more about excise tax a little bit later on. And then payroll taxes include employer and employee contributions toward Canada Pension Plan, employment insurance, and employer health tax. And I'll be speaking about those also a little bit later. Okay, so some of this will be familiar to you because Taras just covered it, and I'm going to go relatively quickly over most of these and spend a little bit more time on corporation and branch. So sole proprietorship, Taras has already covered, and you'll recognize these points from his earlier slides. Generally, a sole proprietor is an individual who carries on business in his or her own name, and the business is taxed in the hands of the proprietor, and business expenses can be deducted from business income. So this is probably the simplest form of organization. And then a partnership. So again, similar to a sole proprietor, generally it's two or more persons acting in concert in partnership. There is a contractual agreement that governs the nature of the partnership. And from a tax perspective, a partnership is treated as a flow-through. So the partnership income is not taxed at the partnership level. It's determined at the partnership level, but for tax purposes, it is flowed out and it is taxed in the hands of the partners in their respective proportions. So that's essentially a personal taxation of partnership revenue. Okay, now a joint venture. Canadian law does not recognize the joint venture as a distinct form of business organization. It is essentially an arrangement where two or more parties share in a common venture, and it's usually a contractual relationship. Profits and loss are not calculated at the joint venture level, and taxation is at the individual co-venturer level. So similar to a partnership, with the main distinction that a joint venture is not recognized as a distinct, separate form of legal business organization. Okay, so now we come to branch. A branch is not a separate legal entity. So what does that mean? It means that in essence, a foreign corporation carrying on business in Canada through a branch will be considered to be the foreign entity itself present in Canada. So a branch is not considered a separate legal entity. So as a consequence of that, any debts, liabilities, and obligations of the Canadian operation will be attributable to the foreign corporation. In addition, the foreign corporation will be subject to federal and provincial law and must obtain a license or otherwise register in all provinces in which it carries on business. So now the tax considerations of a branch. The determination of whether a non-resident is carrying on business in Canada is based on both the common law and the provisions of the Income Tax Act. A non-resident is taxable on their income from carrying on business in Canada, subject to any relief under a tax treaty. For tax purposes, non-residents are deemed to be carrying on business in Canada if they produce, grow, mine, create, manufacture, fabricate, improve, pack, preserve, or constructed anything in Canada, whether or not that is exported or sold before exportation. Also considered to be carrying on business if you solicit solicit orders or offer anything for sale in Canada through an agent or servant. And thirdly, you're considered to be carrying on business in Canada if you dispose of Canadian real or immovable property situated in Canada, in other words, real estate. So if you're deemed to be carrying on business in Canada because you fall into one of these three categories, then in addition to federal and provincial income tax, a branch tax of 25%, which may be reduced by a treaty, and we'll talk about that a little bit later, is levied on the after-tax business profits of a non-resident foreign corporation. The branch tax is intended to approximate the Canadian tax that would otherwise have been paid on a dividend paid by the non-resident paid by the Canadian resident to its non-resident parent. So the branch tax is a way to estimate 25% withholding tax that otherwise would have been payable, and it's a prepayment of that tax, that approximate tax. Now, as mentioned, tax treaties may reduce the branch tax payable by a permanent establishment of a non-resident company to as low as 5%. And in addition, many tax treaties also provide that the first $500,000 earned by a Canadian branch is exempt from branch tax. So branch tax is calculated based on looking at the earnings of the branch less the following: business losses in previous years, so that's deducted. Canadian taxes on the profits other than branch tax, those are also deducted. Profits reinvested in Canada are also deducted for the purposes of calculating branch tax. And then a deduction of $500,000 Canadian or its equivalent in the local currency. So in the net income number, that first 500, so if you have less than $500,000 of net income, given all of those deductions, then you won't be subject to the branch tax. Now, why is it beneficial to operate as a branch? Well, if you expect startup losses in your Canadian operations, then it may be beneficial to operate as a branch because those losses can be consolidated against profits of the non-resident corporation. And if you decide to create a permanent presence in Canada other than as a branch, so for example, as a subsidiary, which we'll talk about in a moment, then you generally can convert on a tax-deferred basis the branch operations into a Canadian subsidiary corporation. So another thing that has to be taken into consideration in operating through a branch is withholding tax. So where a Canadian branch operation receives passive income, such as rents, royalties, or interest, the payer of that income will be required to withhold and remit to the Canada Revenue Agency non-resident withholding tax. However, if this income is attributable to a Canadian permanent establishment, it will be exempted from withholding tax, but will instead be subject to income tax. So what is a permanent establishment? A permanent establishment, and whether that exists, is a question of fact. Generally, it is a fixed place of business through which the business of the non-resident is wholly or partly carried on. Tax treaties generally provide that a permanent establishment includes a place of management, a branch, an office, a factory, or workshop. Depending on the nature of its activities, a branch operation will often have a permanent establishment in Canada. A permanent establishment can arise in many other circumstances. For example, the Canada Revenue Agency considers computer equipment, such as a server that connects to the internet, to be tangible property having a physical location. As such, a server may constitute a non-resident place of business if it is owned or leased and used by the non-resident. This is relevant for non-resident corporations that carry on an internet-based business, so a services business or the business is conducted completely online. In those circumstances, depending on the location of the server for e-commerce, if that is in Canada, it is possible that that will constitute a permanent establishment. However, on the other hand, the mere use of a computer or server owned by a third party will not generally constitute a fixed place of business. So without oversimplifying or over dramatizing, the tax considerations, in addition to the legal ones, are quite complex and technical and really depend upon the facts specific to your particular operations and what it is you intend to carry on, or what type of business you intend to conduct in Canada. So these comments, there's a lot of it depends, and there's a lot of gray areas with respect to what particular facts will be attributable to you or applicable to you, because it really will depend upon the nature of your own business operations and what you intend to do in Canada. For example, this is a very common mistake that I find, or misconception. Some people think that if they have agents or employees in Canada, that they therefore don't have a fixed place of business and therefore they don't have a permanent establishment. And that unfortunately is not always correct. Agents and employees may themselves constitute a permanent establishment if such person has and habitually exercises the authority to conclude contracts in the name of the non-resident. So again, we talked a little bit about the branch not being a separate legal entity. So one of the issues with respect to carrying on business through a branch is that the financial and tax accounting for branches may be more complex than for a Canadian subsidiary. For example, the determination of a branch's proportionate share of the corporation's overall general and administrative expenses can raise difficult questions. Non-resident corporations who wish to carry on business through a branch face the potential problem of preparing financial statements for the branch that are acceptable to both the Canada Revenue Agency and the tax authorities of the country of residence. So a very important thing to be mindful of if you want to carry on business through a branch is that it is not possible to segregate the business operations of the branch and simply present financial information to the Canada Revenue Agency only in reference to the branch. So all of the financial reporting of the parent company, essentially the non-resident company, would have to be made available to the Canada Revenue Agency. And then there is, of course, also the issue, as I raised earlier, about conformity of the financial statements and the presentation of those financial statements with Canadian standards. So also, when a corporation carries on business in Canada through a branch, all of its books and records with respect to the Canadian operations must be kept at its Canadian place of business or other designated place. So often that's kept at the office of the lawyer or the accountant, depending. And they must be made available for audit by the Canada Revenue Agency. Then another issue that does potentially arise is the taxation of non-resident employees. So if you are carrying on business through a branch in Canada and your employees are non-resident, then it depends, the taxation of those employees also has to be considered. And it depends on whether the employees are or are going to become Canadian residents. Employees who become residents of Canada are taxable on their worldwide income, whereas non-resident employees are taxable only on their Canadian source income, which would include any compensation that they receive for employment duties that are exercised in Canada. Tax treaties may provide some relief and may deny Canada the right to tax non-resident employees who are temporarily working in Canada. So again, there are circumstances where, depending on your particular facts, your Canadian resident employees may not be subject to Canadian tax on their worldwide income. For example, if an employee is in Canada for less than 184 days and their remuneration is not paid by a Canadian resident or borne by a Canadian branch, then this exemption may apply to deny Canada the right to tax that employee on their worldwide income. But this exemption, if it is available, does not preclude the obligations of the employer to withhold income tax for services performed in Canada. Other payroll source deductions may also apply. So again, there's complications and technicalities that need to be considered with respect to not only the operations of, excuse me, the Canadian operations, but also any Canadian or non-resident employees who provide services in connection with those Canadian operations. Excuse me. Okay. So moving on. Oh, sorry, just one more thing before we move on. I'm just going to speak to point 5 there. We've talked about taxation. I wanted to talk about some advantages. So there are some advantages to using the branch. So as previously indicated, the first $500,000 of income may be exempt from branch tax. But two other primary advantages are that Canadian business losses would likely be deductible against income earned in the foreign jurisdiction. So you might be able to set off any startup losses incurred in Canada against income of the company in its home jurisdiction, and thereby reduce the overall tax payable by the non-resident. And the second advantage is that, as I indicated, the non-resident corporation can generally claim foreign tax credits for Canadian income taxes paid in connection with the operations of the branch. So there is some relief there from double taxation, and certainly opportunities to reduce the overall tax as a consequence of Canadian operations. Okay, so we'll move on to subsidiary. So again, as Taras has already covered, these are basically his points from his slide, and I'm going to speak more on the tax issues. So in Canada, so a subsidiary corporation, let's start there, is a separate legal entity. So it has separate legal identity, it is its own separate legal person, can sue and be sued. And so the number one benefit of having a separate legal entity is that you can limit the liability and exposure of the operations in Canada simply solely to that Canadian subsidiary corporation. So you get an immediate potential limitation of liability as a consequence. The second issue with having a separate legal entity is that from a reporting perspective, a books and records perspective, you're now only having to report the financial activities of the Canadian subsidiary corporation, and you don't have to report the combined operations, worldwide operations of all of the related companies. So from a disclosure perspective, the disclosure is reduced as far as the Canada Revenue Agency is concerned. So just like we previously discussed, a Canadian resident entity is taxable on its worldwide income regardless of the source of that income. So under the Income Tax Act, the taxation of the corporation will vary depending on the jurisdiction of incorporation. In other words, whether it was incorporated federally or whether it was incorporated in a province, so in Ontario or in another province, and what the tax rates are in those various provinces. It will also vary depending upon the type of corporation, the type of income, and the activities carried on by it. Generally, a corporation that carries on an active business, in other words, provides goods or services, is taxable at a lower rate than a company that earns income from property, which includes rent, royalties, license fees, and those sorts of things. Those are considered passive income, and those would be taxable at higher rates. So in Canada, we have, because there's tax at the federal and the provincial level from an income tax perspective, the combined federal and provincial tax rates for corporations range between 26 to 31%. That's for active business income, and that depends on the province or territory. As we also previously discussed, a corporation is deemed to be resident in Canada if it's incorporated in Canada. And then if there is foreign source income that is earned by the Canadian resident corporation, there is a foreign tax credit generally available for foreign taxes paid on foreign source income. Now, any initial operating losses, so as we spoke about in the context of a branch, initial operating losses can be used to offset any of the loss, any of the income of the non-resident corporation. But in the case of a subsidiary, generally operating losses of a subsidiary are not available to offset the parent's profits. Because we generally don't have consolidated reporting. However, if in your country of where the parent company is located, there is consolidated reporting as an accounting option and a tax option, then potentially you might be able to use losses of a subsidiary. But as a general rule, as far as Canada is concerned, losses are not available to offset income of the parent. Now, another issue that we have to consider is withholding tax. And this is a big issue, and I'll try to distill it to the main points. Basically, a Canadian resident corporation is required to withhold tax on payments made to non-residents of Canada. And that includes dividends, interest, rents, and royalties, which are derived from sources in Canada. And the general withholding tax rate is 25%, but can be reduced by a tax treaty. Now, if a non-resident who is operating at arm's length from the subsidiary, in other words, not a related party, advances funds to the subsidiary by way of loan, there is no withholding tax on that interest that is paid to arm's length non-residents. That's been eliminated under the Income Tax Act since 2008. However, related party withholding does still apply with respect to non-arm's length interest. And the rate of withholding tax for interest paid to related parties can be reduced to 10% if there is an applicable tax treaty in place. Otherwise, it is 25%. Another issue to be mindful of, which often does happen in a parent-sub relationship, is a parent corporation providing management or other administrative services to a Canadian subsidiary. So if the Canadian subsidiary pays management fees to the non-resident, the management fees would also be subject to withholding tax unless they represent reimbursement of specific expenses. Management and administrative fees are generally deductible from income of the Canadian subsidiary corporation. But this is subject to transfer pricing considerations. And without getting into a long discussion of transfer pricing, essentially, we should be mindful of the fact that the transfer pricing rules generally provide a set of rules for how services between corporations are priced for tax purposes. So there's reimbursement of expenses, or there are other transfer pricing methodologies such as cost plus. So what is important with respect to transfer pricing is that the basis for any management and administrative fees charged is properly documented in accordance with the provisions of the Income Tax Act. Otherwise, transfer pricing penalties could be applicable. To the extent that management and administrative fees charged to the subsidiary corporation are unreasonable, the portion of the fees would not be deductible by the Canadian subsidiary and would be treated as a dividend. So transfer pricing is an important consideration in setting up a Canadian subsidiary, especially if there are going to be significant intercompany charges as between the parent, the non-resident parent, and the Canadian sub. So I'm just raising that as another of the many, many things you need to be thinking about on the Canadian tax side. Payroll tax. Payroll taxes are, actually, sorry, before we get there, I'm going to talk a little bit about ways in which profits can be repatriated to a Canadian, from a Canadian subsidiary to a foreign parent. So generally, there are 4 ways. So first is the payment of dividends. So net income or retained earnings can be repatriated to the parent company by way of dividend. And as previously discussed, they are subject to a 25% withholding tax unless it's reduced by treaty. Another way to repatriate profits is paid up capital. So paid up capital is the amount that the non-resident parent pays to capitalize, in other words, to acquire shares of the Canadian subsidiary. So where paid up capital is significant, and where a Canadian subsidiary operation has been capitalized by its non-resident parent, paid up capital can be distributed from the subsidiary to the parent free of withholding tax, even if the subsidiary has undistributed earnings and profits. So that might be a planning point as far as finding ways to repatriate profits. So management fees, rental and royalty payments we've talked about. That's another way to repatriate profits, by way of charging a management fee or by charging a rental fee or a royalty payment. If it's for the use of intellectual property, you would charge a license fee or a royalty payment. So again, those are subject to withholding tax. All of these payments would be subject to withholding tax, which are able to be reduced under Canada's tax treaties. And then intercompany loans is another way in which profits could be repatriated, but we have to be conscious of thin capitalization. And I'm not going to spend a huge amount of time, but it is important to be mindful of the thin cap rules in the Income Tax Act. So when establishing a Canadian entity, you might use a combination of equity and debt. And if a parent has sufficient surplus funds to finance its Canadian operations, it should consider establishing the subsidiary so that it can provide financing through lending to the Canadian subsidiary. And any related interest charges can be used to repatriate profits on a pre-tax basis, potentially providing significant tax advantages to the extent that the Canadian tax rates exceed the tax rates of the parent corporation. And given that Canada has very, very high tax rates, it's likely that in almost all circumstances, our tax rates would be higher than the tax rates of the parent. The ability to finance Canadian operations with debt, however, is restricted by the thin capitalization rules in the Income Tax Act. In very, very general terms, the thin cap rules limit the deductibility of interest by the Canadian subsidiary where there is a high level of debt owing to foreign shareholders or related non-residents relative to the level of equity. The thin cap ratio is 1.5 to 1. In other words, the interest deduction by the Canadian subsidiary on interest it pays to its non-resident parent is restricted where there is debt in excess of 1.5 times the equity. So the financing of a Canadian resident subsidiary needs to also be considered with respect to the combination of debt to equity and staying within the thin cap rules. So I just wanted to raise that because it is important consideration. Okay, and then filing requirements. So very generally, where a corporation carries on business through a subsidiary, the filing requirements, the Canadian subsidiary will be required to file a Canadian tax return. It will be required to prepare Canadian compliant financial statements, and there will be no combined reporting as between the Canadian subsidiary and the foreign parent. And similarly to a branch, all books and records of a Canadian subsidiary must be kept in Canada, either at its place of business or other designated location, either the office of the lawyer or some other designated location. And filing would be annually for both income tax and goods and services tax. There might be a more frequent filing requirement for goods and services tax or excise tax, but we'll get to that when we get to GST in a moment. And here we are, GST. Again, as previously discussed, a goods and services tax is a value-added tax of 5% that's imposed on goods sold or rented and services provided in Canada. And in Ontario, we have a harmonized sales tax system, which harmonizes provincial sales tax with the goods and services tax. So we previously had a provincial retail sales tax system and a federal goods and services tax system. In Ontario, we now have a combined harmonized sales tax system, which includes both of those taxes, and the combined rate in Ontario is 13%. So if you are a non-resident person and you have a permanent establishment in Canada, then you are deemed to be resident in Canada for the purposes of the goods and services tax. And I'm going to refer to it now as GST. And so you may be required to register for and collect GST on all taxable supplies of property and services that are made through the Canadian permanent establishment. So we've talked about what the difference is between GST and HST. And now we'll talk about carrying on business in Canada. So we previously spoke about this in the context of income tax, and there is a similar rule for carrying on business in Canada for GST purposes, but of course, to keep our lives interesting, it's a little bit different than the rules for income tax. For carrying on business means for GST purposes that the business activity in question is done regularly or on a continuous basis. So the definition basically includes or contemplates making a taxable supply in Canada. And I'm going to talk about what a taxable versus exempt or zero rated supply is. But before we get there, I'm going to talk about some of the factors that are considered in determining whether a non-resident person is in fact carrying on business in Canada. So some of these will include the place where the employees or agents are located, the place of delivery of the good or service, the place of payment for the good or service, the place where purchases are made or assets are acquired, the place from which transactions are solicited, the location of assets, the place where contracts are made, the location of a branch or office, and the place where services are performed. This is just a few of the factors that are considered in determining whether someone is in fact carrying on business in Canada for GST purposes. Just again, to make our lives a little bit more complicated, the mere fact that a non-resident person undertakes an activity that falls within the definition of business does not mean that the business is being carried on in Canada. So again, it's very fact specific, and it's very important to be aware of what your particular facts are as to whether or not you are in fact subject to GST or HST. So now we'll talk a little bit about taxable versus exempt or zero rated supplies. So we have three different types of supplies under the Excise Tax Act in Canada. There's taxable supplies, which are taxable in Ontario at the full rate of 13%. There are exempt supplies, which are not taxable at all. And then there are supplies that are taxable, but they're taxable at a rate of 0. And I will very quickly tell you what the difference is between them. So taxable supplies are the majority of supplies, and most property and services that are supplied in or imported into Canada are subject to GST or HST in Ontario. So here's some examples of taxable supplies: sales and rentals of commercial real property, sales and leases of automobiles or car repair, taxi or commercial ride-sharing services, publications such as books, magazines, periodicals, rights to operate franchises, hotel accommodation, and of course, just the general provision of goods and services, whether those are professional services. So for example, lawyers' fees are subject to HST, it's a taxable supply. So there's a very broad range of things that are considered taxable supplies, and if they are taxable, then you are required to charge, collect, and remit 13% HST in Ontario on the supplies being performed. So now zero-rated supplies. Zero-rated supplies are still taxable supplies, but GST applies at a rate of 0%. This means that you do not charge GST on these supplies, but you're able to claim something called an input tax credit. And an input tax credit is essentially something that the seller of the service is able to claim for the GST that they may have paid on property and services that they had to acquire to provide the supply. So an example, you provide a certain service, you have to buy certain supplies in order to be able to provide your service to your customer, and you pay HST on the supplies that you have in fact purchased for your business use. You can claim an input tax credit for the taxable supplies that you had to, for the tax you had to pay to acquire the supplies that you needed to provide your services to your client. And that goes with taxable supplies as well as zero-rated supplies. Anything that is considered taxable allows you to be able to claim input tax credits. So some examples of zero-rated supplies are basic groceries, agricultural products such as wheat, grain, raw wool, and dried tobacco leaves, prescription drugs and drug dispensing services. And then exempt supplies are those supplies where no GST or HST applies. Generally, those are medical, health, dental services, many educational services, and most services that are provided by financial institutions. So lots to think about there. It's a complicated act. The Excise Tax Act is complicated. There are many rules and exceptions to the rules, and the general rule is it's taxable unless it's specifically excluded as either an exempt or a zero-rated supply. So that's the rule of thumb. So if you're subject to HST, if you are required to charge and collect HST, then what are the registration requirements? Well, you have to register for GST if you provide taxable supplies, including zero-rated supplies. You make taxable supplies of admissions in Canada to a place of amusement, for a seminar, an activity, or an event held in Canada. So if you are an event business and you hold events in Canada and you charge admission, you have to register for GST. If you sponsor or host a convention in Canada and more than 25% of the delegates are Canadian residents, or you solicit or offer for sale in Canada books, newspapers, magazines, periodicals, or similar printed publications. So you can see that there's some odd carve-outs, like if you provide taxable supplies, which generally most businesses will, unless they are qualifying as providing exempt supplies, you basically have to register for GST and HST. And you register if you are a company or a partnership. Branches and divisions generally do not register separately for HST. They cannot register separately. So the non-resident corporation that carries on business through a branch has to register for HST. But a Canadian resident corporation or a Canadian resident partnership would register for the GST as a single entity. You do not have to register if you are a non-resident who does not carry on business in Canada. And as I've touched upon, you it's very fact specific whether or not you are considered to be carrying on business in Canada or not. And there's a huge list of factors that are to be considered in making the determination of whether a non-resident is in fact carrying on business in Canada or not. But if you're not carrying on business in Canada, you don't have to register for HST. Or if you are a non-resident and you sell taxable real property located in Canada, other than in the usual course of business. So if you are a non-resident, you sell Canadian real property, but it's not in the course of your regular business, you do not have to register for HST. And then we do have an exemption for someone who's considered a small supplier. A small supplier does not have to register if it meets one of the following conditions. If you are a sole proprietor and the total amount of revenues is $30,000 or less, so you can see the threshold's very low. You are a partnership or a corporation and the total amount of all revenues is less than $30,000. Again, unlikely and not probably beneficial because you could still claim input tax credits potentially. And then finally, if you are a public service body like a charity or a not-for-profit, and the total amount of all of your revenues is $50,000 or less, you don't have to register for GST. So finally, the filing requirements. When someone registers for GST, the filing requirements are assigned, the reporting periods are assigned at the time of registration. And they're basically determined based on total revenue from taxable supplies. So when you register for HST, you call or contact the Canada Revenue Agency, and they ask you some questions, one of which is essentially, how much revenue do you expect to be earning from your taxable supplies? Based upon that response, you're either going to be a monthly, a quarterly, or an annual filer, and you will be required to report and file a GST return on the basis of your the amount of your revenue as you disclose to the Canada Revenue Agency. The filing and remittance due dates will be based on your reporting period. And it's important that there are director's liability issues to be contemplated here, to be taken into consideration. Directors of corporations may be held personally liable for unremitted HST. And penalties and interest may also apply for late filed unremitted GST or HST. So again, I'm using, sorry, I realize I'm going between GST and HST in my reference to it. Director's liability and penalties and interest will apply regardless of whether it's GST or HST. I'm just using HST because in Ontario, we're a harmonized sales tax province. But the same rules apply. You could potentially be personally assessed liability for unremitted HST. There's also a requirement to maintain adequate books and records, and that is a requirement in the Excise Tax Act as well as in the Income Tax Act, and it's required by every person who carries on business or is engaged in a commercial activity in Canada. And all books and records must be kept for a period of 6 years. Okay, so payroll tax we'll just speak about relatively quickly. Essentially, payroll taxes are those taxes that relate to employer and employee matters. So we have Canada Pension Plan, which is our national retirement plan, I suppose. Employment insurance, which is to provide benefits to unemployed people when they apply for it and if they require unemployment insurance to be paid to them. There's also employer health tax in Ontario, and there is, as with GST, there is a potential liability, personal liability of directors for non-remittance. So payroll taxes generally are deductible from most types of remuneration payable, including salaries, wages, bonuses, and commissions. So if you have an employee rather than an independent contractor, then as an employer, you are required to deduct and remit contributions from the amounts and benefits paid and provided to employees. So if you pay your employees a salary or even an hourly rate, but you are paying them their wage as employees and not as independent contractors, then you as an employer are required to deduct income tax, Canada pension plan contributions, employment insurance contributions, and potentially employer health tax if you are required to remit that. And that would be deducted from the employee's paycheck, and they would receive the net amount, obviously, of that pay. A non-resident, so a non-resident employee who is performing duties in Canada and who is an employee is still required. The employer is still required to withhold Canadian source deductions on the salary that's paid to the non-resident employee. And I'm just briefly going to speak about one other thing that does apply to non-residents who carry on business in Canada. I did speak briefly about that a non-resident person who works in Canada might be subject to Canadian income tax, either on their worldwide income or on just their Canadian source income. But there's also potentially another tax that applies, excuse me, where a Canadian resident person makes a payment to a non-resident employee who is rendering services in Canada. And it's called Regulation 105 withholding. And very briefly, Regulation 105 tax is on account of any applicable Canadian income tax payable by the non-resident by reason of carrying on business in Canada, and is equal to 15% of the amount paid for services rendered in Canada. This generally is a tax that applies to branch operations, but it is also possible that if you have a non-resident person who is providing services to a Canadian resident corporation, that Regulation 105 withholding might also apply. So just another thing to be mindful of is that we do have potential other complications with non-resident employees who are providing services in Canada. Just a very brief note on employer health tax. Employer health tax is a payroll tax in Ontario, and it's based on compensation that is paid to employees, and it's payable if you are an employer and you have employees who physically report to work at your permanent establishment in Ontario, who have employees attached to your permanent establishment. In other words, they may not physically report there, but they are connected to a permanent establishment, or they do not report to work at any of your permanent establishments, but are paid from or through your Ontario permanent establishment. So you can see that there's a very broad net that captures employees who might be subject to employer health tax remittances. Now, there is an exemption amount. So if your payroll is $490,000, you're not subject to employee health tax. And finally, as previously discussed, like GST, directors can be held personally liable for unremitted payroll taxes. There is a due diligence defense, so the directors can claim a defense, same for GST, to say that they exercise due care and diligence in performing their duties and should therefore not be personally liable for unremitted GST or payroll tax. Okay, so we've talked about withholding tax already, so I'm not going to talk about it again, other than just to give you again a outline of the withholding taxes, the circumstances in which withholding taxes could potentially apply. And we talked about thin cap, so everything here I've already covered. So we'll just move on. Okay, tax treaties. So we have both tax treaties and tax information exchange agreements. Now, tax information exchange agreements are relatively new. And we have, they've been enforced since 2011, and there are 23 currently in force. So a tax treaty obviously is, we have 94 tax treaties in force in Canada. There are 3 that are signed but not yet in force, and 8 that are under negotiation, and 23 tax information exchange agreements in force. So tax treaties, relatively straightforward. They are usually based on the OECD Model Convention, and their mandate is to eliminate double tax and reduce withholding tax between signatories to these treaties. But tax information exchange agreements are mechanisms to exchange information with tax haven countries. So those countries that have a low tax or no tax, generally a no tax jurisdiction, like a low tax jurisdiction like Barbados does have a tax treaty, in fact, with Canada. But a no tax jurisdiction like Cayman Islands has a tax information exchange agreement because there's no double tax that's occurring, as Cayman Islands does not have an income tax. So what are TIAs for? What do? They allow for the automatic exchange of information between multiple jurisdictions. They're intended essentially to avoid tax evasion and tax avoidance by allowing an exchange of information between tax haven countries and Canada. So the TIAs share information relevant to the determination, assessment, and collection of taxes, the recovery and enforcement of tax claims, and the investigation or prosecution of tax matters. So they encourage foreign countries by extending favorable exempt surplus regime to foreign affiliates. So what does this mean? Generally, where a country that does not have a tax treaty with Canada because it does not charge income tax, enters into a TIA, a tax information exchange agreement, then profits from a Canadian resident corporation, a subsidiary corporation, can be repatriated to the non-resident parent at favorable exempt surplus, and you'll be extended the more favorable repatriation regime if you are a signatory to a TIA, which allows distribution out of exempt surplus of a foreign affiliate to its Canadian resident parent. Okay, so I don't know why I don't go to the next slide. Anyway, we've covered all of that. The last thing in my last 2 minutes, I'm going to cover just very, very basically the Investment Canada Act. This applies to every foreign acquisition of a Canadian business and any investment to establish a new business in Canada. So as such, it's important for you to be aware of the compliance with the Investment Canada Act. So first of all, it applies when a non-Canadian establishes a new business in Canada or proposes to acquire control of an existing business, whether directly or indirectly. A Canadian business is defined as a business carried on in Canada that has a place of business in Canada, an individual or individual in Canada who are employed or self-employed in connection with the business, and assets in Canada used in carrying on the business. So if you fall into any of those categories, then you have to comply with the Investment Canada Act. And so there are review processes potentially applicable that are a review of significant investments over certain specified financial thresholds. The thresholds for review are generally for transactions or investments in excess of $1 billion. However, it's again important to be just aware of the fact that there is a review process for investments in Canada or setting up a Canadian business which might be applicable to you depending on the circumstances. And the review process considers whether such investments will be of a net benefit to Canada. And so in all cases, a proposed investment in Canada by a non-Canadian seeking to establish a new business or acquire control of an existing Canadian business, the non-Canadian must file either a straightforward notification of the investment or a much more detailed application for review. Again, the filing of either of these will depend upon the financial thresholds that might apply in the case of the business that's being carried on. And that's really all I wanted to say about the Investment Canada Act. And as you can imagine, and as you have probably guessed, there's so much more complexity to any tax considerations in terms of setting up a Canadian business. They're not insurmountable, and certainly we can assist you with them, but you need to be mindful of the fact that for the most part, the determination of how to carry on business in Canada, what structure will work for you, what taxes you might be subject to, the optimal way to structure your business ventures into Canada are going to depend upon your particular facts and circumstances, and we are of course pleased to assist you with that. And with that, I think I went 1 minute over time, but I am pleased to have any questions or answer any questions that you may have.
Thank you very much, Sabina.